In chat, I want everyone to finally get invited to the Google Classroom. Should work. All right. Give me one moment. I'm just inviting like 3 more people. Sorry about my delay. Just life be life. But this is not a long chapter. It's chapter 2. It all will work out. And thank you all once again. My name is Terrell. I am the owner of PRXNCE.TAX. I have been in business for 10, we're going on 11 years now. I'm so grateful and thankful. Most people tax firm don't go past 2. So for me to be doing 11, that's really a blessing. With that being stated, what I do is I help CPAs, tax professionals, enrolled agents scale and maximize their profit through tax preparation services. And I also perform business and personal tax return preparation. And that is why you all are going to be my tax partners next year. I'm just inviting everybody, and give me one moment. You all should have the link, but if you don't, just want to make sure y'all get it. So I'm just sending everybody the link. We are live. Thank you all once again. We're about to start this up. Cool. That's everybody. All right. So to start, first thing we finna talk about today is going to be, I ain't gonna do the cross link just yet. It's gonna be right now. Computer catch up. Standard deductions and exemptions. That is what we'll be discussing today. Standard deductions and exemptions. And to start, you already know you go to the Google Classroom, you hit the chapter, standard icons, and we're going to be going to the PowerPoint. I highly recommend everyone else, when you get a chance, that you do. What's up, Antonio? Welcome to the party. Welcome to the party, Ms. Cora. That you do. Oh, Ms. Ritchie in, coming in. Everybody coming in. Thank you for the opportunity, everybody.
Woo!
Hey, bro, I hope all been well, man.
Yeah, man. Gang good. Cope study.
Okay. Love it. Antonio was with me last year. Cora was with me last year. Always gotta love it when people come back and rock out with you again. But as I was stating, do check out chapter 2. If you already don't know, I have added in the Google Classroom link and the Zoom link. I've also emailed it to you all. When you get a chance, do read chapter 2. It ain't that long. It's only probably like maybe 40 pages. But today we're going to be doing the PowerPoint. And before I do that, I'm actually going to go over the learning activity from last week. And then we're going to do the PowerPoint. All right, so here we go. And thank you all for tuning in and tapping in with me. And rock out. Oh, and this year, it's 80% of your own personal returns that you will take home, and 8% of my returns my prior year clients. So just to let y'all know. All right, so here we go. Learning activity. Kimberly Whitaker, age 37, Social Security number 24500057888, and her daughter Sierra, age 9, Social Security number. And the reason why it's set up like this is because Kimberly Whitaker would have filled out an intake form. She would have stated that on the intake form that she was age 37. She didn't state it and given us her social security number so that we could file her taxes. She would have also given her daughter's name, her daughter's age, and then she would have actually gave like the date of birth for her daughter. That's very important. You'll see in a few moments when I start a return. And then next, you'll see that you had to have the social security number for the daughter also, who lives with Kimberly. And so the scenario is Kimberly also lives with her mother, and they all live in one house. And the reason for this learning activity in chapter 1 is we are doing this activity to determine who is head of household in the home. Okay. And the way it would work, and it's really cool the way they broke it down, especially with the ages difference. And I guess I would have to presume that Kimberly mother is older than Kimberly Whitaker. That's that's her mother. So we're gonna see. All right, so use the following information. And the information is expenses paid by Kimberly, expenses paid by Kimberly's mother. So you would have inputted the electric amount paid by the taxpayer. The taxpayer don't pay no property taxes. So that would have been 0. Let me see if I got a pen on here. I probably do got a pen on here. Let me see. Annotate. Oh, that's not what I want. Hey, boy, we're gonna get so much money in 2 months. Just know we finna make so much money. So much money. We all gonna make money. Everybody just put that in your mind. This is money team. We getting money over here. I'm trying to see if I could get a pen. A little pen. Let's see. Annotate, remote control. All right, never mind. But so taxpayer is Kimberly, okay? Just want y'all to know. Taxpayer Kimberly. Others, that would be Kimberly mother. All right. So Kimberly don't pay no property taxes. Kimberly mom pays $280. So you would put $280 right here for Kimberly mom. Then mortgage interest expenses. So that means that most of the time, the person that pays property taxes is going to pay the mortgage interest also. And that's because the mortgage interest goes along with the property. And by property, they mean like real estate, and that type of situation. So the mortgage interest expense, $3,202. That's gonna be her mama. She get that. Now the rent. So let's see. Do anybody pay rent? Nobody pay rent. So that's 0 for nobody. Y'all see where I'm getting the numbers from? I'm pulling the numbers from the information they provide. Utility charges. So utility charges would be things like electric and water. Those would be utility. So you add them up, 2,149 plus 480, 2,140, that's 2,580 plus 49. So you take 20. Now you add 2,600. And then you add the other $29. So you have $2,629. All right. So that's utilities. Somebody write that down. Utilities was $2,629. All right. And then you got upkeep and repair. So Kimberly did that. She paid $1,500 in upkeep and repair. So now you got $1,500 right here. Property insurance. The mama paid the property insurance. So she had $280. All right. Then food consumed on premises. That would be $2,600 for Miss Kimberly, and then food for $600 for Kimberly's mother. Then other household expenses would be the telephone, which would be $576. And so what you do is you add up all the totals. Okay, so Kimberly totals, and then you add up Kimberly mother totals. And when you add them all up, you will see that Kimberly pays more of the expenses or pays more than half of the cost of maintaining the house. And that's what this exercise is about. Because sometimes you have to do a worksheet just to kind of help your client or the taxpayer better understand who is head of household and who gets to claim who and so on and so on. So that's what exercise and learning activity 1 was all about, okay? Just wanted to go over that with you all, so that way when you all do try to do the example on your own, you can watch the YouTube video. The YouTube link does go up maybe like 2 days later, and then you can always play this back to see exactly how the example works. But Kimberly is definitely head of household in this situation, and Kimberly gonna get a crazy recheck, crazy refund. You know what I'm saying? And the reason for that, because she got her 9-year-old daughter, and she get to put her mama on the as a dependent, but her mama ain't gonna be no child, not like that. I'm gonna show y'all. I'm gonna break it all down to you. But just know Kimberly and her mama gonna be real happy as they come file with PRXNCE.TAX. All right, so boom. So that's chapter 1. Now, before I continue, do anybody got questions? Cool. Anybody? Just want to make sure. Everybody get that opportunity to ask questions. And I do hope everybody got access to the classwork. I have invited you all. I'm the teacher. That's me, Terrell Valerie. And yep. Most people have accepted. Some people still need to accept, but everybody pretty much, yep. Everybody in there like swim well. I bet. And that's all the people I have worked with in all my years. So that's why that is what it is. That's why you see everybody. I love this set up. Okay. So chapter 2, standard deductions and exemptions. Comprehensive tax course. All right, let's talk taxes. Module 1. Today's learning objectives: calculate the standard deduction and determine when to use it, define what constitutes an exemption, and identify when a taxpayer can claim an exemption, summarize the test for determining when a dependent is a qualifying child or a qualifying relative. And that's what I just was discussing when I was talking about Kimberly Whitaker and her mom and the fact that she has a child. This chapter right here will further explain to you how to determine who is a qualifying child and who is a qualifying relative. A relative is someone that is related to you, and you can claim them, but you're not claiming them for the purpose of the EITC credit, which you all will learn about also as we continue throughout the course. And pretty much everything I'm talking about and the verbiage I'm using, that allows you to build rapport with your client, because your client don't know what EITC is, or they probably don't know what a qualifying child is. And that's why you're there to be that mediator and that one-on-one person or that professional that allows them to kind of better determine, oh, okay, so I should claim this and I shouldn't claim that. All right. So determine support provided to a potential dependent. That's important, because you can't say that's your qualifying child if you don't provide no support for them. So just be thinking about that. And describe the steps necessary to file a descendant's tax return. And then also identify the rules for tax withholding and estimated payments. All right, so key terms: descendant. I just want to make sure I'm saying that descendant. Yeah, I'm saying that right. And I'm recording, so I hope I'm saying it right. Oh, they're going to talk about me on YouTube. All right, then deductions in respect of a descendant, and then dependent, and then estimated taxes, exemption, income in respect of the descendant, phases out, qualifying child, qualifying relative, standard deduction, and withholding. All right, so standard deduction. So you probably heard this once or twice before when you was in discussion with anybody that was talking about taxes or finances. And standard deduction is an established dollar amount which eliminates the need for taxpayers to save receipts to itemize. And also, it is adjusted each year for inflation. So you'll notice that the standard deduction in this year, which is 2018, when I got this information presented to me, is that the standard deduction around this time was about $6,000, okay, for a single person. You will now notice that in the year 2025, the standard deduction will actually be around about $16,000. And what that is telling you, and all this will make more sense as you file taxes and as you do your own, individual research, and I highlighted it, is that inflation is a major factor in everything. inflation isn't just interest rates for housing. Inflation means the dollar is losing value. And it shows itself because in 2018, the dollar had half more value than it did now, which is why it costs half more, which is why it costs $16,000 for you now to take care of yourself versus back in the day, it only cost $6,000. And you're gonna see it's gonna all make sense as I continue to class, but just be aware that as you look at the numbers, just understand that. And then amounts varies depending on filing status and other factors. Again, that's what I was just stating when I was talking about a single person back in 2018, they only gonna be at 6,000. Now, a married filing jointly, which is two people together, would have been at 12,000. And you're gonna see these numbers. And you also can Google these numbers by typing in 2025 standard deduction. And then you're gonna actually see the amount for 2025. And the reason why it's already there is because every year Congress meets and then they discuss what will be the inflation rate. And that's just how this all works, which is why tax professionals always pay attention to what be going on in politics, because those rules determine the tax laws. And they got some new tax laws too that I'm gonna discuss with y'all as we get further down the road. And y'all probably heard of some of them. Now, some of them are a little bit of a myth. Some of them will actually happen, and some of them actually are planning to get voted on within the next month or so. So taxes kind of changes. So you can't always say that you know everything because the tax law changes. So just always remember that too. So always be aware of what's going on in politics, especially right now, because there's so much going on. So just remember that. And standard deduction is zero if the taxpayer is married and filing a separate return and his spouse itemized deductions. And that's important. So somebody that has a zero standard deduction mean that all their income from the year, they're not going to get taxed on it. Versus a standard deduction mean that your first amount up to this point, then I'm going to start taxing you on it. Not me personally, but the IRS. That's how it works. All right. Then standard deduction chart for most people. You see what I'm now? Y'all remember I was saying 6,000? The actual number is 6,350. Do we all see this part? If you do or don't, it's okay, but I do want you all to recognize this on the playback. So back in 2018, $6,000, $6,350. Once a person made $6,351 at work, they had to start paying taxes on it. That's the best way to explain it. All right. Then married filing jointly. Even though it's two people and they're going to two different jobs and they're both W-2 people, when they bring it together and they file together, which is what married filing jointly means, when they file their taxes, they first $12,700, no taxes on it, okay? But then once they make $12,701, they now owe a tax. And in America, just to give you some more help, the tax rate is not a standard rate, which means not everybody gets taxed at the same amount. You actually are taxed based on a gradual scale, which means as you make more money, you actually have to pay more taxes. But then the way the tax law is also set up, as you make more money, when you hit certain numbers, you didn't receive a tax break. So that's also important. And that information that I'm speaking to you, if you go do the research outside of the class, you will build rapport with your client because they'll be like, dang, they really know what they're talking about. Versus that person up the street that was just talking about they wanted to file my taxes at Starbucks. So just remember that. Like the information I'm saying, and if you could repeat it back and know what I'm talking about, you're going to kill it. I'm telling you, because that's the main reason why people are going to come to you. Because I'm like, I don't know what I'm doing. So I'm going to go to Antonio. And I ain't never filed my taxes by myself. So I'm going to go ask Naya. I don't really know nothing about even how to start my taxes. And I got back file returns that I need help with. So I'm going to go ask Miss Ritz. That type of thing. Make sure I ain't got nobody in the waiting room. All right, everybody good. You know? So just always remember that. All right. And then they got examples. Lily is 26 years old, has never been married, and does not have any children or any dependents. Lily will file a tax return using single filing status, and her standard deduction will be $6,350. So pretty much what they're saying is anybody who is unmarried and doesn't have any children, they're a single person. Only reason why a single person would become head of household is if they have a dependent, which is like with Miss Kimberly Whitaker with the example earlier. Miss Whitaker has a child, so she can become head of household if she is one, provides more than half the support for the home. And then it's also she need to have a lease in her name or at least have a mortgage or a written out agreement saying that the home is in her name, because that's important too when it comes to the IRS. I just want to put that in there so y'all can always know that. All right. And then another scenario, the scenario is the same as example 2. Lily and her husband now have a son who was born during the tax year. Lily and her husband have decided to file separate tax returns. Since they are still married and living together, they must use the married filing separately filing status. They will both use the standard deduction. Lily's standard deduction will be $6,350. All right, so to further explain why somebody would actually use married filing separate, all right, so sometimes say Lily only was a homemaker, and by homemaker, she didn't actually work a job. So because Lily didn't work a job and she actually was taking care of the child, she doesn't actually have any tax liability. Now, her husband, on the other hand, he worked all year and he had to pay for them bills. He had to pay for everything in that career. You know what I'm saying? To make sure Lily and the son, you know, the little baby that just popped out, was all good. You know what I'm saying? But while he was doing that, he so happened to listen to a friend of his at work on lunchtime. And it was like, man, you know, you go tax exempt, right? And he was like, what that mean? Tax exempt mean you don't pay no taxes. What you mean I don't pay no taxes? And then so he decided to go tax exempt, and now he ain't been paying taxes all year, and he done made $50,000 for the year. All right, so that $50,000 that he made, remember I told y'all, up until $6,350, he didn't owe no tax. So once he made 6,351, and then all the way up to 50,000, he owed tax on that money. Y'all get where I'm coming from? All right. So because he owed tax and Lily don't owe tax, Lily say, you know what? We still married, but you gotta have your own tax liability. So that means that you're gonna pay your own taxes that you owe to the government, because you owe that to the government. And I don't owe no taxes. You know what I'm saying? So just remember how that break down. That's the reason why somebody would use it, but at the same time, they don't really have to. And that's the reason why they had the discussion with their tax professional. Because say Lily and her husband didn't live in the same household the last 6 months of the year. Not that they were legally separated or divorced or anything like that. But if Lily lived in a different household than her husband in the last 6 months of the year, and they stated that to you, then they can legally file as single. And Lily will actually be head of household versus single, because she actually claiming a child, and then her husband will file as single. And so that's just something to just discuss. But that's only if the client tells you that. You can't tell the client what's going on, because remember, you're a tax professional. So the client is giving you the information, and then you prepping the files for the IRS. That's why we call tax professionals. But you always do probe and ask questions. Always ask open-ended questions when you're talking to a client, and always be honest and very transparent. Because remember, your PTIN, which is like your tax professional social security number, is linked to every return. All right. So standard deduction for age 65 and older. So when you're 65, the government say you didn't live so long, we're gonna give you a little extra benefit. And when you older or blind, you get a little extra benefit. So this is extra money that the government say, I know that you got this going on. So because you got that going on, we ain't gonna charge you for that, because we're gonna give you that allowance. So that's what these is. That's what a standard deduction is. Just pretty much an allowance that the government gives to a taxpayer and they like, all right, so you made that money in our country. We good with you making that money. But once you make more than that, it's time to start paying taxes. Just remember that, okay? And anytime y'all got questions, y'all can always call me and go in deeper detail. But that's pretty much how it works. So this is a chart. In the chart, it breaks down if you're a person over 65 or older. And the reason why they used to have these charts is because taxes wasn't always e-file. It used to actually be a situation where you had to fill out the chart to determine, if a taxpayer was a head of household, if a taxpayer was blonde, blah, blah, blah. And all of it used to be handwritten. So just remember that. It didn't always used to be a computer and as easy as it looks now. So that's why this was very important. And that's also the reason why they sped it up and did decide to go to e-file, because that was causing problems and it was causing a delay. All right. So examples, just want y'all to know that. Then standard deduction for dependents. So dependents deduction is limited if the taxpayer can be claimed as a dependent on someone else's return. So when you run into them individuals that be like, I'm in college, I live by myself, so on, so on. I pay my own bills. But in reality, my Dukes back home is really the one paying the bills. They just got that crib because they're in college, because they're in a different home, in a different city. You always want to probe and ask, like, okay, so I get you in college, I get you filing by yourself, but you know that if a college student actually file with their parent will get a bigger amount for them versus the college student just trying to come get their American Opportunity Tax credit. So you always be like, well, I know you want to file by yourself, but did you work during the year? And if they didn't work, then necessarily they should file with their parent and then have a parent file them, and they go from there. And most of the time, when I was in college, I didn't even know nothing about this like we know now, but college students are very, very intelligent now. So I'm pretty sure parents are getting those questions, especially like when they're looking for that $1,500 or that $2,500, because that's what the American Opportunity Tax Credit is. You're gonna learn about that tax credit also. It's in like chapter 5 or 6, something like that. All right, but that's what this is. So this is if you're a dependent of another. And if they say, so the way that scenario will work with the college student, it will be either that college student worked a job where they made more than the standard deduction, which is at this time was $6,000, unless they was blind or are over the age of 65, which because they're in college, so they ain't over the age of 65. They might be blind, so you still ask that question, unless you technically could see them in person and be like, oh, but you still ask the question, just to understand. It's nothing offensive. It's actually a benefit for them. All right. So in this situation, the college student, they 26, they did work a job, so they did make more than $6,350. They will file a return for themselves. But the way I would do it is I would let the college student file with the parent get the big check. The parent cut the college student a little money. That's how I break it down to the parent. And then I will file a child return by themselves. And you will wait till the parent return goes through first before you file a child. Because if you send the child return up first, you just messed up on the e-file system. And now you got to mail in the parent return and they got to wait 2 to 3 months. So that's why you also want to ask that question too, because say you do file a college student and you didn't ask the questions that I just asked, and you just went ahead and just filed a college student, like, oh, I got a client. Oh, yeah, they got this, they work. And now their parent coming trying to file, and now their parent can't file, and now they got to wait 3 months, all because we sent up the child return before we sent up the parent. So you always want to ask that question, always. Now, if you got a question about what I'm talking about, you can stop me and be like, hey, Terrell, what you talking about? Just want you to know that. But mainly standard deduction is the amount that the government say we not taxing you on this. And it's gonna all make sense when I start the learning activity, which is at the end. I'm gonna do the learning activity on Crosslink for you all today and show you how to start a return. Then I want you all to go into the Crosslink software and I want you all to start a return with your name or with your spouse name and just get used to it. And you all will get logins for that no later than, what's today? It's Tuesday. So I say no later than Thursday, you'll have your Crosslink login. So you'll get to do what I'm about to do in a few moments. And you'll get to play with the software and stuff like that. All right. So who should itemize? itemization, what exactly is it? You probably heard the word, Terrell, what is this? So itemize is the situation with the receipts. These are individuals that kept their receipts all year for groceries. I'm gonna show you what they can itemize too when I go on the software, because the software made it so much smoother. It's like a sheet of paper, and then you just write it out. But you can't itemize everything on because you got a receipt on it. But the cleaners, anything that was related to like it just used to be crazy what people used to itemize. And so that's the reason why they kind of stopped the itemization and they don't really want you to do it as much. And that's just also the reason why people state don't return as much of a refund when you itemize. So just want to explain that. And you're going to see what I mean. So itemized deductions on the Schedule A. Boom. Look at the software. It already knew what to say next. So what's the Schedule A? The Schedule A is where you add the itemized deductions. What are the itemized deductions? Here we go. Out-of-pocket medical, dental, and prescription expenses. So anything that you had to pay that wasn't copay, you get to claim that when it comes to medical, dental, and prescription. You also get to claim the miles between your home address and the doctor's office. You also get to claim the miles between your home address and the dental's office, your home address and the place where you buy your prescriptions. If it's Walgreens, you get to claim that mileage. All right. Mortgage interest and real estate taxes paid on the taxpayer's home. So remember how we was talking about Kimberly Whitaker's mother in the learning activity 1? Well, if Miss Kimberly Whitaker mother were to file a return, she could actually claim that $3,000 in mortgage interest, and she could also claim her property taxes on her Schedule A. All right. And most of the time, the mortgage interest is going to come in the form of a mortgage interest 1098, which is a form that the client would go get from their lender who is providing them with the mortgage, and they would just call and you can help them with that call. Again, that's another way to build rapport. Anytime you can help a client, you're winning. Just remember that. You're never losing. Anytime you and a client can do something one-on-one, you're building rapport that will then tell someone else about you, and your business will grow. Trust me. But always keep your word, though. That's one thing I will always tell you as a person who just wants you to succeed. Keep your word. So if you tell a client you're going to send them something, send it to them. Even if it's a day or an hour late, you make sure you still send it to them. Don't ever not do it. Just always remember that. And you always want to try to stay on time, but life does happen, as in like earlier. That was the best example with me being a little late with starting the class. All right. So cash and non-cash contributions to qualified charities. So anytime they do donations, they get to claim that, whether it be local church group, nonprofit organization, buying turkeys to give out on Thanksgiving, like some people, me, do tell people about that. I got 1,000 pounds of turkeys I give out on Thanksgiving. Check out PRXNCE.TAX to learn more. If you don't already know about PRXNCE.TAX, I suggest you do follow us on Instagram and Snapchat. All right, then unreimbursed employee expenses. So that's really important to you all. So say right now, you all are I say you all, I'm so country. We are all tax partners. You know, I'm from the South. We are all tax partners. And because we are tax partners, each one of you is a 1099. And because you're a 1099, you pretty much have employee business expenses. And even though I say employee would have been you all, if one of you worked as a secretary for me and there was parking tolls or parking fees because the office is located downtown, and those parking fees and parking tolls that you kept receipts of, you bring it to your tax professional, you now get reimbursed for that. That's what unreimbursed employee business expenses. But in the situation of each person on this Zoom call, we are all business owners. We all are our own owners. And you are actually contracted work contracted tax partners with PRXNCE.TAX. So you don't have employee expenses, you just have business expenses that you get to claim. And you learn about that in chapter 11. I teach that like the last class after we take the real test. And then other miscellaneous expenses, and it say miscellaneous because it can be anything. It can get wild, but that's the reason why you are the tax professional and you tell the client, well, I don't think you should report this much, because at the same time, the more you report, the more the IRS will want to look into your return. Always remember that. All right, married persons who file separate returns. Both spouses must use the same method of claiming deductions. So that means if one itemized, both must itemize. If one don't itemize, the other one can't itemize. And they both got to use the same tax form. You learned about tax forms in chapter 1 when it used to be 3 different forms, the 1040EZ, the 1040A, and the 1040. Now it's really just the 1040 due to the crosslink and other tax software and stuff like that. All right. Review question 1. So I am going to ask to see if you all will try to do the review question with me. I know we all may be a little busy or occupied, but we're going to try it. Okay, let's see what happens. Leo and Maria, that's Maria? Yeah, Leo and Maria are both over 65. They have one dependent, Maria's mother, who is legally blind and 85 years old. Leo and Maria will file marriage filing jointly. What is the standard deduction amount for this couple? So, let y'all think about it for a little minute. And then whoever wants to volunteer to answer can answer in 1 minute. We ain't gonna do a whole minute though. I ain't got that much patience. All right. So I'm gonna go back to the chart so that way you can all understand what they're asking us. So they're talking about Leo and Maria. These are 2 tax clients, and it came to PRXNCE.TAX, and they want to file their taxes. They have one dependent, Maria's mother, who is legally blind and 85 years old. All right. Leo and Maria will file marriage filing jointly. What is the standard deduction amount? Okay, here we go. And remember, Leo and Maria are both over 65. Here we go. All right. And that's how so this what you're looking at now is what fills in automatically in the system. So each one of these questions would have got answered. It would have been like, so taxpayer would have been Leo, spouse would have been Maria. Born before a second, 19. So each one of these would have doop, doop, and that would have popped up in the box and made it auto-populate over here. And then the answer come in. And then if they both blind, boop, boop, it's going to add it up, and then you get your total. That's how the new system works. But back in the day, though, they had to actually fill it out and like remember and put it all in. So just want to go back to it just so y'all understand. Just where the real chart is. Yeah, it's coming up. It's coming up. All right, so this is the one we need. Standard deduction chart for people 65 and older and / are blind. So they 65 and older, Leo and Maria. We already know that part. Boom, boom. They both got that. So they're married filing jointly. Y'all remember that? When they say married filing jointly, they ain't single and they ain't filing married filing separate. And Leo can't file head of household because he claimed Maria. So married filing jointly. There'll be 13,950. That would be the answer. Okay? Just want you to understand that. Well, actually, because of the boxes, watch this. So I don't think they was blind, but I know they was born before this. So that'll be 1, 2. So because they both are blind, it's actually gonna be 15,200 because you got 2 people that's both blind. So watch this. You see how I got you? That's why you had to look at the boxes and you got to read what the chart says. So I'm going to go back to it one more time just so we all catch it. That way, when you're doing it by yourself, you understand what the chart actually saying. So check the number of boxes below, then go to the worksheet. Taxpayer Leo, he was born before 1953. Taxpayer Maria, she was born before 1953. They is not blind. Then the total number of boxes checked would have been 2 right here. All right, remember that. Let me go to a real example. All right. Leo, Maria, check, check. 2 boxes checked. So next you go to F, the filing status is married filing jointly. You see how it's all working? Boom. So now they got 2 boxes. Then your standard deduction is 15,200. All right. Look at y'all answering questions. Kind of. That's how it works. And then what we have, answer B, 15,200. And then we also had D at 13,950, which would have kind of seemed like it was the right answer if you forgot the fact that because they said something about Maria's mother who is legally blind and all that, but she ain't got nothing to do with this right now. Only thing we talking about is the fact that who is filing married filing jointly and what's their standard deduction. And so that's why I came up to the 15,200. All right. Now, Audrey is single, legally blind, and 85 years old. What is her standard deduction? All right. So this time, Audrey is single, legally blind, and 85 years old. All right. So scroll up. And the chart is in y'all chapter, by the way. But, you know, if you're doing a PowerPoint, this is how it works. So now we got Miss Audrey. We got one person. She is born before 1953, and she is blind. And so that's 2 boxes checked. Her filing status is single. And then you go to the 2, 9,450. That would be her standard deduction. And then we go to the answers. And we got 9,450. Look at that. Y'all gonna be the best when you actually got somebody in front of you. These some old people too, by the way. I ain't gonna even lie. These some old clients. Nothing against the old or the elderly. Nothing against them. Dang, they up there. All right. Jason and Lisa are both under 65, married, and will file separately. Which of the following statements is true? This let's change up right here. And just to help you out, the key word in this one is the will file separately. Boom. So the answer would be C. Just so you know. It could have been D, but it ain't. Married filing separate individuals can file itemized deductions. It's just that they both have to file it. So the answer would be C because Lisa filed claiming itemized deductions. Jason had already filed. He didn't know that she did that. So now he got to go and amend his, she got to go amend her return to do the standard deduction. So that's how that goes. But there could never be a situation where Jason will claim standard deduction and Lisa get to choose standard or itemized because they are choosing filing separate. So when they choose to file separate, they both have to do the same type of deduction. So they both got to itemize or they both got to do standard. But it's not mandatory that they only do standard only. So just remember that. All right. Review question number 4. Got one more review in me. Marvin is 66 and single. He lives with his adult son and his wife. They claim Marvin as a dependent. Dang. But Marvin is 66 and single. He lives with his adult son and his wife. Dang, Marvin. Marvin must have had a tough time. They claim Marvin as a dependent. Marvin received Social Security, and he also worked at Walmart. What? And earned $3,000 in the year. Walmart withheld federal tax. Marvin wants to file a return in order to receive a refund of the withholdings. What is his standard deduction? All right, so this question got a lot of stuff in it, and that's normally how it be when you're talking to your client because they're gonna tell you all about their life. They're gonna tell you everything they got going. When I say everything, I mean everything. So they definitely gonna tell you where they stay. They claim Marvin as a dependent. So that's the part that's important. So because they claim Marvin as a dependent, he doesn't. His standard deduction is actually different than a normal deduction, and that's what we was discussing when we was talking about dependents. I just want to show you what I mean. All right, so. All right, got to use the standard deduction worksheets for dependents to determine his standard deduction. All right, so this is 2017 deduction for worksheet for dependents. So Marvin is 66, so he over this 1, 2. He ain't blind, and it's just Marvin, so that's one box. Probably another box I could use. So I better get this number. Yeah, it should have another chart for me. All right, so here you go. This is pretty much the main thing. The limit is the greater of 1,050 of the taxpayer earned income for the year plus 350, not to exceed the regular standard deduction. So what they mean is that's a 17. We talking about Marvin. Okay, so it would be one box here. Check. Enter the taxpayer's earned income. Marvin would be 3,000. Additional amount be 3,050. You add lines 3,350 plus the minimum standard deduction, and you add all that up. 3,350. Go back to it so that way we all on the same page. So 3,000 plus 3,350 plus 1,000 is gonna bring Marvin to a B. He should be at 6,350. Even though he was a dependent. That's how it should all work out. Wait, no. Actually, it's gonna be 3,000. That's what he earned plus the 350 plus 1,050. No. Unless he don't get the standard deduction because he can't go over 4,000. So boom, Marvin is gonna be B by itself. And we got that one. Good job, team. And sometimes you got to work it out so you can kind of see what they're talking about. But the main thing to always remember is nowadays, you ain't got to do all that. You literally going to put this information in the computer, and the computer going to do most of it. But you still have to have an idea of what the standard deduction is, because sometimes, like I do, I actually do it without even putting it in the computer sometimes. And it just allows me to move faster. But you will learn how to do that over time. Trust me. All right. So exemptions. Exemptions are the amount that the most taxpayers are entitled to deduct from their income before computing tax liability. Exemptions can be claimed for a taxpayer, spouse, or qualified dependent. All right. So next, this is very important. A Social Security number. A Social Security number must be provided for all dependents. And what that means is everybody that go, you're gonna see what I mean when I go into the tax software. Everybody that goes down as a dependent gotta have a Social Security number and it gotta have a date of birth. And the most important thing I want you all to take from this is if a child was born and died in the same year and the Social Security number was not obtained, attach a copy of birth certificate and death certificate and hospital records. Sometimes that can work. That might be really important in Georgia because in the state of Georgia, unborn children actually get an EITC credit. But again, everything is different. You just got to be aware of it. And then you got to know the different state laws too, because you don't just file Alabama clients. Just want you to know that. Well, I hope you won't, because you can file all 50 states. So it just depends on you how much you want to learn and what you want to learn. All right. And then I-10 is our taxpayer identification number. It's just not the Social Security number. It's an I-10. And that just means that somebody that gets to work in the country, but they're not actually a citizen. So they don't have a social. They consider that alien. Not like alien, like UFO and nothing like that. We talked about that last time. All right, so phase out. Personal allowance, phase out threshold. And this is what I was talking about earlier. These are the amounts where both the taxpayer and his spouse qualify for income exemption even if one spouse had income. For married filing separate taxpayers, if the spouse had no gross income, the taxpayer can claim an exemption for that spouse without their consent. A child cannot claim an exemption for himself if his parents are eligible to claim them. All right, so the exemptions, this is really important when you're filling out your HR form. And a lot of times what's going to end up happening when you being a tax professional is you going to talk taxes, but you're really going to be talking about somebody, what they're doing when they're at the work or on the job, because those answers, when you first fill out that information, really determine if you're going to owe taxes or if you're going to make some money. So like they were saying with the individual Marvin, he worked 3,000, made 3,000 in a year, but he had taxes withheld out that 3,000. That's what he's filing his taxes for. He wants the money that he had withheld. But if you don't put no money in it, you can't get no money back. So remember that when you're talking to people, because everybody be thinking so different. All right, and you got some charts, more charts. All right, dependent taxpayer test. If the taxpayer can be claimed as a dependent by another person, he cannot claim anyone else as a dependent. Even if the taxpayer has a qualifying child or a qualifying relative, he cannot claim that person as a dependent. And what they're saying is, if somebody claims you as a dependent, you can't file a return and claim somebody else as a dependent. Okay? Because somebody took care of you. And dependent means that somebody provide more than half the support for you for the year. And this is what it's going to show. So watch this. Joint return test. The taxpayer generally cannot claim a married person as a dependent if that person files a joint return. So what this is saying is, if you have a taxpayer in front of you and they are married filing jointly and they already did a tax return, but then the individual come back and try to do another tax return with somebody else, it won't work. Okay, because they already filed a return. That's just what this is. And the reason why these are important is because this allows you to explain to the taxpayer what is occurring with the IRS. It's just a cool way to break it down. And these are the actual names of the information. So, citizen or resident test. The individual must be a U.S. citizen. All right. And as I was stating earlier, a resident alien of the U.S. is a U.S. national or Canadian or Mexican resident. All right. Then they got exemptions. So adopted child. So if the taxpayer is a U.S. citizen, a U.S. national who has legally adopted a child who is not a U.S. citizen, U.S. resident alien, or a U.S. national, and the child live with the taxpayer as a member of the taxpayer household all year, they are now an adopted child and they now qualify as a full citizen. Just like when people get married, you know what I'm saying? They had that situation where they go over into Peru and the islands and stuff, then they come back with a wife and then they marry him, or they come back with a husband, that type of thing. Okay. Review question number 6. I'm not doing a review question. Test for qualifying child. So these are the 5 most important things you should remember when you're in front of a client and they're trying to figure out if they should claim this child on their tax return. 1 is the relationship test, which means are they related to them and how are they related? And can they prove it with a birth certificate? Because if they cannot prove it with a birth certificate, guess what? You're not related. It don't work. Age test. So you remember how Kimberly Whitaker was 39 and we actually didn't get her mom age? So the reason why that is important is because that is going to determine. So a child younger than you can't claim their parent. You know what I'm saying? So what that means is that person can't, my daughter can't claim me, but I can claim my daughter. So you just got to remember that. And then you got the residency test. So residency means the person lives with this person. So one situation is my daughter has to live in my home more than 6.5 of the months for me to claim her. All right. But if she didn't live with me more than 6.5 of the months, 6.5 months, then I can't claim her because she wasn't being my residence. All right. Then you got the support test. And I'm just using my daughter as an example. Shout out to Ariella Grace. Shout out to my daughter. All right. Then the support test. So the support test. So you can't say that this is your qualifying child and you do not support them. And support can be everything from paying for school to taking them to the doctor, taking them to just everything, like paying for school, food, clothing, just taking care of the person and making sure that they're good. Doctor, what else is another good one? You got the doctor. They go to the dentist. They do everything. Like they little people, so they do everything a big person does. It's really interesting. And then joint return. So again, if the person you're trying to claim has already filed a return as married filing jointly, then of course they wouldn't qualify as their child. And this just further breaks down what the relationship test is. And the child is the taxpayer's brother, sister, half brother, half sister, step brother, step sister, a descendant. For example, the taxpayer's niece or nephew. All right, so these are the only ways you can claim someone as your child. They can be your brother. Well, the child is the taxpayer's brother, sister, half brother. The person you're claiming can be your brother, your sister, your half brother, your half sister. It can be your stepbrother. It can be your stepsister. It can be a descendant. It can be which is like your sister's child, your sister's son, your sister's daughter, your brother's daughter, yeah, that type of thing. But it can't be you claiming my dukes, and you can't claim your uncle, and you can't claim, so I can't claim my uncle, but my uncle could claim me. Remember that. And then the age test is important. So again, at the end of the year, the child is under the age of 19. Okay. At the end of the year, the child is under the age of 24 and is a full-time student. So, all right, full-time student. There are some situations where, children being high school a little longer than the normal estimated 18, 19. So that does sometimes occur. And then there's also situations where a child can attend college, and because they're in college, they now are your child, even though they're over the age of 24. So just remember that. And then there's examples. Residency, which means that they live with you. Remember that. And we're moving. We're doing good. We're doing good. I hope everybody's still awake. Hope y'all doing well. All right, special rule for a qualifying child of more than one person. So in my situation, my child Ariella qualifies for me, and then she also qualifies for her mother. So only one person can essentially treat the child as the qualifying child. Always remember that. Tax benefits cannot be shared between the eligible and the ineligible taxpayer. So only one person gets to put the child on a return. No, not both people could put the child on a return. The ineligible taxpayer may be eligible for the taxpayer benefits if he has a different qualifying child or she has a different qualifying child. All right. Then the tiebreaker rule. So if one of the persons is the child parent and the child is the qualifying child of the parent, if both parents claim the same qualifying child, the parent with whom the child lived with the most during the year can claim him or her. If the child lived with each parent equally, then the IRS would award the parent with the higher AGI, or the one that makes the higher amount. If neither parent can claim the child as a qualifying child, the person who had the highest AGI can claim him or her. And again, the person with the most money, that's pretty much what they're saying, the person that has the most money can actually claim the child. Then if a parent can claim the child but does not do so, the person with the highest AGI can claim the child, but only if the person's AGI is higher than the highest AGI of any of the children's parents. So what they're saying is, say a grandparent decides to claim a child, and as long as they make more than the parent, any one of the parents, then they can therefore claim the child. So it's all about support when it comes down to it. And this further breaks down it. Child live with parent has higher AGI, two persons claim the same children, and how does it work? And this does happen and occur, but always remember, you got to have a birth certificate. You need to have school records. You need to have medical records. You need to have a lease in their name if they're going to claim head of household, unless they're going to be single. And those documents allow you to properly prepare the tax return for the IRS. And those are the same documents that you must retain over 3 years for any reason, because the IRS can pull a return and ask you questions about it because you're the tax professional. But they'll really be asking me because it's my tax firm and you all are my tax partners. So, always remember that. And then they got more examples. All right. Applying this special test to divorce or separated parents who live apart. All right. So this is pretty much the main one that most people, you might situation. All right. The custodial parent if eligible, the child as a qualifying child for head of household, the credit for the child dependent, the exclusion for dependent care. So, and then they kind of break it down. What is a qualifying relative? A qualifying relative is somebody that's a member of your household that passed the relationship test and you provide more than half the support for them and they don't make more than the standard income. So they're not your child, but they live in your house and they could be perhaps related to you. They don't have to be, but they're a member of your household and they don't make enough to where they can like support themselves. So you provide the other half of the support. Just remember that. And these are individuals that can help you become head of household if you had that type of situation. Because head of household get a bigger standard deduction than single. Because you take care of a household. All right, so support test. Hey, we doing real good. We in the 60s. All right. All right, I hope y'all still awake out there and thank y'all all for tuning in. We're almost up out of y'all. All right, determination of support. So what actually means that you support? This means that you provide food, lodging, clothing, education, medical and dental care, recreation, transportation, and other necessities for the child. Items not included in total support: federal, state, and local income taxes paid by persons, life insurance premium, funeral expenses, scholarships, Social Security, Medicare taxes. And then they got an example of expenses paid by Michael, household expenses paid by Verna, expenses paid by Verna paid for Michael, that type of thing. And that just kind of shows, say Michael is living in your home, Verna's the real owner, Verna pays for Michael expenses such as these things, or it's one of the situations where Michael is the child. He's, like I say, he got a part-time job after school. He earned $3,500. And that's, that's pretty much how I go. Multiple support. Mm-hmm. All right, filing the tax returns for descendants. Descendants. These are like people that passed away. All right, I just wanted to make sure. A final return must be filed if the filing requirements are met. A personal representative administrator executor must file a final return and return is not for the pursuit. The word deceased, the descendant's name and date of death should be written across the top of the return. If someone other than a spouse or personal representative is claiming a refund for a descendant, he should file a Form 1310. All right, so what they're saying is sometimes when people pass away, they probably was working a job and so on and so on. And you can file a tax return based on if they worked a W-2 job. But that's only if you have power of attorney and things like that. This sometimes does occur. Sometimes people go to jail. Before they went to jail, they was working a substantial amount. They can file their taxes. It just be a lot of life, just be lifing. And when life is lifing, you still have, taxes that are owed. And that's just what the IRS still allowed. Or there could be taxes withheld that is owed back to the taxpayer, which is why they receive a refund. All right, the survivor may qualify for certain benefits, inherit property, a joint return, descended as a dependent. All right. Then that's a further breakdown. And then return assembly. So when you are starting a return, forms are identified by using the numbers. Schedules are identified by using letters. A sequence number is found in the upper right-hand corner of the form, which tells you what it is. And return should be assembled with the form number associated with it. All right. Then how to actually process a return. Determine filing method, which will always be e-file. Preparer must sign every return Taxpayer must sign every return before filing, and it's now e-file. And taxpayer must be given a complete copy of the return. So every customer that filed with me, they get a copy of their tax return. They used to get a printed copy, but now they just get a digital copy, and then that way I ain't got to charge them to print because paper ain't free. All right, next thing, tax withholding must complete form W-4. So remember, I was telling you the form that you fill out with your employer when you first start. That's what this is. So the 4 types of information included on the W-4 is the amount withheld at a single rate or lower married rate, number of withholding allowances. And you know how to be people talk about 100 on there. Don't be putting 100. A safe recommendation for a client is I would tell them maybe put 9 or 10, as they did have to put an allowance because they do have outside expenses, but no more than 9 or 10. Then if the taxpayer wants to put an additional amount, which is normally what I do when I go work a job or something like that, work a part-time, is I actually pay additional because I know that I want that to cover the amount that I make from working my regular, career, which is all money in, no taxes paid most of the time. So by me going to work for another employer by W-2 or something, it allows me to use their taxes to pay the taxes that I would normally have. All right, then balance due return. So this is important. All right, most individuals who might be in a situation like myself where they receive their money and they do not pay taxes on it, like throughout the year, not saying that I don't pay taxes, but most people don't actually pay quarterly taxes. Most individuals just kind of wait till the end of the year. They bring their information in, and then they see what they owe. I do not recommend taking that route. You can advise your client, but hey, look, I highly recommend you start doing your estimated tax payments, which is where you divide the total amount owed, you divide it by 4, and that client makes payments April 15th. April 15th. I think it's April, then it's every 3 months. So it's April. Yep, July 15th, April, July. Then it's gonna be another 3 months. Then it's October, April, July, October, and then it starts off January. Yep. And that's how that goes. So it'll be January 15th, April 15th, July 15th, and then October 15th. And if the customer did decide to make their estimated tax payments, now when they file, they're going to receive a form, just like a mortgage interest form from the government. And they're going to be like, hey, you paid this much, so now you don't owe us. And that just allows them not to be in that balance where they do. Because you don't want to be in red. Trust me, it's not fun. And I'm the tax man, so I'm never in red. But just understand that it's not fun to be in red, especially when you don't have a tax man or be a tax man like I am. So just want y'all to know that. All right, then exemptions from withholdings. The taxpayer can claim exemptions for withholdings if both of the following apply. So these were the people that go tax exempt, as I was talking about earlier. Only time someone should go tax exempt is, I say never. I don't like none of my clients that go tax exempt. But some people like to do 3 months on and then turn it off for the rest of the year. But I wouldn't recommend it because in the beginning of the year, when you're working, you're not being taxed anyway because you haven't made a certain amount just yet. So I wouldn't recommend that. And then at the end of the year, if you work the full year and then you cut it off, that's the reason why you now owe, because you now owe taxes more than anything because you worked so much. So when people cut the taxes off from, like, some people like to do it from, I guess, let me say October to December, and they like to use that money to go pay for like Christmas and things like that. I highly tell them not to do it. I'd be like, don't do it. You know what I'm saying? I know it seems like it's a come up, but in actuality, it's not. I just recommend you just let them keep getting their little $50. And then when it's tax time, we'll get you every dollar back, versus having to owe them. That's just my recommendation. But everybody different because we do not live in a household, but that's just the way it works. All right. Then we're holding on tip income. So individuals that work based off tips, bartenders, waitresses, Uber drivers, taxi people. Tip income is subject to federal and state tax. Again, the tax law have changed a lot recently since 2017. So when it comes to tip income for the year 2025, it's actually up to $25,000, I believe. It's either 25 or up to the standard deduction that they're not being taxed on their tips. Then after that, they tax just like everybody else. That's what the new tax law is on tips, just so everybody knows. All right, withholdings on taxable fringe benefits. Certain non-cash fringe benefits can be considered part. All right, so fringe benefits is when you get like a company car and things like that, or you get like a company credit card, things like that. Those are fringe benefits. All right, withholdings on pensions and annuities. This rule applies to distributions. So you're gonna run into people who have IRAs, ROTs, SEPs, ISEPs, individual IULs, whatever it could be. They're going to have life insurances, pensions, annuities, and all these come on a form. The form you get from the life insurance company, the place where they got their pensions and annuities, the stock bonus plan. Sometimes that's already on the W-2 and it shows what they got. You'll see that in the other boxes when you ever have next time you got a W-2 in front of you. But just know each one of them is an earning income, so you do have to pay taxes on it. All right, so people that gamble, my gambling people, my people that like to gamble, withholding on gambling winnings. So regular gambling withholding is 25% of the gambling winnings. So if you win $1,000, you owe the government $250, something like that. Then back up withholdings. Now, so that means 28% of the gambling winnings. So back up withholdings means you won, but you didn't pay taxes on it. So now you owe more. You owe 3% more. All right, withholdings on unemployment compensation. Even though it's unemployment, you still have to pay 10% of each payment withheld for income tax purposes. So a lot of individuals they didn't understand that, and when COVID happened in 2020 and 2021, a lot of individuals had unemployment. They never had unemployment before, and they didn't cut any taxes on it. I know that they had to elect to cut taxes on it. So a lot of individuals did actually owe from that unemployment, which is again why it's important for you to be well knowledgeable and versed in what's going on and occurring in politics, so that way you can help out your client. All right, we're holding on federal payments. So even if you get Social Security, Tier 1, payments under agriculture, you still got to pay some taxes in some way, form, or fashion. So estimated tax was the one where I was just telling you about your estimated tax payments. You get that when you file your taxes. So in 2020, the estimated tax payments for 2026, the person will get the estimated tax payments for 2027 you get when you file your 2026 taxes. The estimated tax payment for 2025, you got that when you filed your 24 taxes. The estimated tax for 24, you got that when you filed your 23 taxes. And the reason why it's called an estimate versus your actual tax that you will actually owe is because say you make more money the next year than you made the last year. So you now owe more taxes than you did. So that's why it's called an estimated tax. So as long as you make that installment payment, you either pay it in full or you can make an installment. As long as you're doing that, you're going to win. Then boom, the taxpayer does not have to pay estimated tax for the following conditions. He had no tax liability. He was a U.S. citizen for the whole year. And his 2015 tax year covered 12 months. All right, so there is a penalty for people who choose to underpay the government. So that's one of the reasons why a lot of individuals get hit with the letter when they go to the file it when after filing their taxes, they receive an audit. It's called underpayment. And underpayment is when, okay, the best way to put this is an individual paid. So the government, the IRS, the Internal Revenue Service, they get a copy of every form that you get in the mail. They expect your return to come in the same as the return that they got when they got the mail-in form from the employer. So the employer gives you a form, they send one to the IRS, and they send one to the state that you live in or that you proclaim to live in. That's the reason why it's 4 pieces on the W-2. Because it's 4 pieces that was mailed. There's one for you, one for the IRS, one for your records, and one for the state. All right. But they expect that to come in. But as we all know, all because I made $15,000 don't mean my $15,000 I made for the year just sit in my bank account. My $15,000 allowed me to pay for groceries, medical, dental expenses, so on, and those itemized deductions. So when you claim those itemized deductions, it allows you to get some of that money back. But if you don't file your taxes, or if you do file your taxes and you overclaim too many deductions, you're in a situation where you're now in penalty because you underpaid on taxes, which is why some individuals get in trouble. All right. Hey, I just was breaking it down. Oh, so I said the dates wrong. So it's April, June, September, and January. Those are the days when you pay your estimated taxes every 3 months. And by doing this, if an individual is a truck driver, Uber driver, someone that owns their own business, like everybody that's on this call right now is a tax partner. If you make a certain amount, you're gonna want to start doing estimated tax payments throughout the year, because then instead of you owing $10,000 all at one time, it was just 1,500, but it was just 2,500, 2,500, 2,500, 2,500, versus having to give somebody $10,000 at one time. So, and you don't really care about the fact that you're giving $10,000 because you done made so much more. So you okay with paying your taxes. That's why I'll be okay with paying taxes. I have no problem with paying taxes because I just make so much. It's okay. It all works out in the end. I'd rather pay him and be balling than not be able to pay him and can't ball at all. Yeah. Then other types of withholdings would be Social Security, FICA. You might have seen that on your W-2s or your pay stubs. Then Medicare tax. Then you got state withholding tax. Then you got the locality tax, which is like Birmingham or Trustville or whatever city you live in. Then you have state unemployment insurance, and then you have state disability, SUI, SDI. All right, I'm gonna do one review question, and then I'm gonna actually do the learning activity with you all and show you how to log into Crosslink online, so that way you all can try to do the learning activity and start it in the software and go from there. All right, so review question 15, and I thank you all for your patience and tuning in and tapping in. We're about to be wrapping it up in about another 30 minutes, and thank you all. Sorry about my delay. We would have been done by now. Larry and Sharon are married. Larry works outside the home and made $50,000 during the year. Sharon does not work. They have no children. Larry and Sharon do not itemize their deductions. How should Larry complete his W-4 in order to have little or no refund at the end of the year? Larry and Sharon are married. Larry works outside the home. Okay. They have 50,000. Sharon is a homemaker. They have no children. How should Larry complete his W-4? All right, so Larry will put he's married. And this is a question that you're most likely going to get from a taxpayer to yourself. This is your tax client asking you right now. So Larry and Sharon are your tax clients. They are married, and they want to know how should they fill out their W-4 form for next year so they don't have to pay any taxes. That's normally what occurs the last conversation that you have with a client after filing with them, because now they're aware that, hey, taxes matter, what they do on their W-4 form matter, and they want a solution. Nobody wants to just keep messing up, trust me, or just wants to keep thinking they're messing up. So that's the reason why they came to you also, for that advice and that guidance. So you'd be like, Larry and Sharon, because you're married, I want you to fill out your form, and I want you to put he will file married, and because he's filing married, they're already claiming him and Sharon, because that's what that means. And he would really technically claim zero allowances because he has no children. So that would allow him to pay the most in taxes, but then he would get it all back. So A would be my choice. But if you was reading these options, some people like to file as exempt, because Larry like, hey man, I ain't finna pay no taxes. I don't care what the government got going on, and I'm gonna get my 50 and take care of my wife. Well, when Larry do that and he chooses to pay no taxes at all on his W-2 income, what Larry has done, is cause him and his wife now to have to owe when they file their tax return. So that's not always the best suggestion. And then file married with 3 allowances. This would seem like this would be correct, but it's actually incorrect because filing married already means you already have 2 allowances that the government is giving you. And Larry don't have a 3rd allowance because he don't have any children or anything like that. So he wouldn't be able to do 3. And then file single since there's only 1 income with 0 allowances. So the reason why Larry wouldn't choose this one is because Larry don't file his taxes as single. Larry files his taxes the next year as married, filing jointly. And that's the reason why he would do file married and claim 0 allowances, just to fully break it down to you. So you wouldn't want to say that you're single on your W-4 form with your employer, and then when you come file your taxes, the next year you actually married filing jointly. Because what you've done is you short yourself and how much of a standard deduction you can get. Because remember, a single person gets less of a deduction than married filing jointly. Okay. All right. Bet. And that was chapter 2, and that was standard deduction and exemptions. I am Terrell on the PRXNCE.TAX. And now I want to go over this learning activity with you all right quick and show you all how to start it in the computer. And I do hope you all have access to your Google Classroom. If you don't, you have been invited. And everything I'm doing, you can replay and play it back on YouTube. So if you did miss anything, you can see it all back on YouTube. All right, so here we go. All right, so bang, here we go. Learning activity. Robert and Mary Lou Rowland. This is what I would like you all to do. Okay, everybody that's on here, you will get your login no later than Friday. Okay, no later than Friday, you'll get your login and crosslink. Okay, and I'm gonna help you. I'm gonna show you what it is I actually do. All right, so when you get your login, some of you login already work, some of you login don't work. This is how it works. It let me just go in. Okay, I probably might still be. Let me sign out so y'all can see it. You're gonna get a login. Then you're gonna create a password. Okay, you're actually gonna get a login. And the way you get to Crosslink Online, I just want you to understand how to get there. And this can be accessed on your laptop, on your phone, on pretty much anything that has an internet device. So you just type crosslinkonline.com. And then it pops up. Of course, my login pops up. You would type in your login name. You would then type in your password. I think that's the right one. Yeah, that's the right one. Then you hit continue. It's going to send you a code to your email that you have given me to register. Boom. You're going to go to your email. I gotta go to my email. I'll be reading my emails. Boom. Oh, 2 people want to go to my class. I do sell houses too. I just want to put that out there. And on my birthday, I'm having a home buyer workshop. So, y'all interested in getting a home? Come see the kid. I am him. All right, then you copy the code. You put the code in. You hit submit. And now you're in Crosslink. Now, of course, your dashboard will not show everybody because, again, You're not the owner of the company. But your dashboard will show your 1040s, which is your personal returns. It will show your business returns, and it will also show your rejects. Rejects we have discussed can happen for various reasons, which is why you see these three right here. And it always happens for different reasons with each client. Um, and you just do your best to resolve it when you do get in those type of situations. And I come like chapter 8, 9. I'll go in further detail on exactly what rejects are and how that occurs in the software. So first thing first, you go to tax returns. You gotta stop the share right quick. You cannot minimize. Let me see. I'm gonna show y'all this. Cannot minimize that part. All right, hold on. Where did this screen even come from? Oh, look. I took the share off right quick. I'm trying to do so right quick. Okay. That's not how I do it. Yeah. Two 2940056 2945500. I'm about to add y'all back in. Give me 1 minute. Boom. That's my Zoom. Now, I can share with you. Ooh. Okay. All right. Boom. So, and I believe you all can now see my screen, correct? You could like do a thumbs up, nod, shake your head, say yes, no. But this is how it goes. So you would take the information, Robert Ryland, that's his name. You see this part, Robert Lou Ryland. So Robert is 45, so you put in his date of birth. So his date of birth is 08/15/2020. So he was 45, so he was born in he old, like 1970. All right, boom, that was close. So he's 45. So Robert was born in 1972, I believe. Nope, that made him older. Okay, so he was born in 65. Okay, that made him older too. 19, he needed to go up. So Robert got to get younger. So Robert was born in 19. Dang, Rob, you up there, bro. Let's do 82. In the 80s. Boom. Yeah, so you're going to be 85, 1985. Nope, too young. So you're going to be 19. Damn, how old is Robert? 1981. All right, so 43. I'm trying to get to 45, y'all. So it's going to be 78. How about 79? All right, boom. All right, and then you type in Robert. Y'all see me? Y'all can say yes, no. It's okay if y'all stay there. All right, so you type Robert Riley. And this is literally what I'll be asking you all to do in the real world. Like I'm gonna send you a return. It's gonna have all the personal information in it. And then you just go to work. And then they got 3 kids. So boom, 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 Robert Ryland. Where he live at? Robert live at. See, it's gonna tell you where they live at. 18S Songbird Drive. And then he followed with his wife. So since he following with his wife, the way so if you got questions and you wondering what to do, you hit the little eye icon, and then at the top it tells you what goes in the field description. So since he filing with his wife, he would be a 2 because he married filing jointly, and then now you would put in his wife information, which is Miss Ryland, which is Mary Ryland. And you all will get to do practice returns, but this is pretty much what it is. Mary Ryland. And then how old is Mary? Mary is... Mary's 40. Okay, got him a young buck. Okay. 10, 8, 19, 17, 19. Okay, boom, 1984. Then you gotta put in her social. And when you put in the social for the people, just give them your own special number. So you see how they got the 2 missing numbers right there? That's how you know that ain't a real social. In the real world, you'll never have 2 missing numbers in the middle. So when you do it, you'll be like 222. And if your special number 17, that's the number you put right there. Then you put the 17. You just put the number in, boom. And now you got Marion Ryland. And this is a practice return. And you just keep going. Do everybody see what I'm doing, though? Do y'all get it? We see it. 18S Songbird Drive. And then you type in the address. And like I say, you can literally do this on your laptop, MacBook, do whatever you want to do. And then you put in your city where you at. If you in Los Angeles, you put Los Angeles. If you in Birmingham, you put Birmingham. And this is the part I wanted to show y'all, dependents and children. So they got 3 kids. So you got Robert and Abigail, who are twins, and then you got Robert Jr. So if you're a junior, I mean, he got the same name as his dad. So that's Robert Ryland. All right. Put that part in. Then Robert Ryland Jr. They got Sandy. Oh, Robin and Abigail are twins. Then they got Sandy. Right. Okay. 7/24, 19. And then you put in the date of birth, 7/24, 1999. Okay, he a little too old. That's unless I'm gonna make them all students just so y'all can see that. Let's see. Yeah, Sandy Ryland. Sandy's 19. Also. Okay, and then Abigail. And they twins, so that'll be 07/24, 299. I'm I'm actually gonna make them younger, so that way we can just see what it is. 2000. Everybody 2007. Make everybody 17, so that way you can get a good grasp of what I'm doing. So everybody gotta have a social, and this would be their son. And then again, if you want a description, just type son. Stay with them 12 months. That's what that means. That's what the daughter. That's stepdaughter, but this is a regular daughter. Yeah, they got a birth certificate, and they got the same. Ooh. Then you gotta give them socials, and then they socials. Well, you ain't gotta give them one because they're gonna provide it to you. So 222-513-619. So you would type these numbers in, you would put them in, and then you'll put your special number in the middle. If your special number is 17, that's what you put. 222-1720. Keep giving them these things. Nobody has the same social. If they're twins. Remember, each one of these kids that they're claiming, they got to be able to provide a birth certificate, just proof that this is their child, birth certificate, school record. And then also you'll see that the software, we'll talk about marketplace and healthcare. I'll discuss that. And then this is where you put in the client referrals, you'll put in the customer bank information, and all this is on the client intake. They receive it and they digitally fill it out. You also put in the client driver's license information here. You would then also stay if the client is male or female. You'll put in a email address, so it'll be rylandtest@gmail.com. You'll put in a phone number. And Ryland out. Then it tells you what his occupation is. And Ryland is an accountant, and Miss Ryland is a veterinarian. And then you just keep going. And then you just type everything in. And then the next thing I want to show you is you're going to add the form. And then when you hit add form, which is located in the bottom left corner, you're then going to select W-2. And you'll see that it allows you to do one for the taxpayer and one for the spouse. So we're going to do Ryan first. So he's the taxpayer. I think we all should be on the same page now. And then you just hit add. And anytime you're wondering what you should do next in the software, you'll just hit verify. And some of them you may not be able to clear. And say you want details or more information about what exactly that is, you just hit verify first, and then you double click, and it takes you right to what needs to be filled out. And signed 8879, there'll always be a yes. So you'll put the X right there, indicating that they did sign the 8879. The 8879 is the form that allows us to e-file a return, which is what you're doing. So every client must sign an 8879. And then, as you can see, if the taxpayer is in front of you, you'd be like, do you consent to receive the documents remotely? You'll say yes, yes. And then you would include, yep. And then you just keep going. Keep going until you ain't got no more verifies. And it takes you right to it. But the main thing when you're doing the W-2 is whatever you see here, you put this information. And this is the data entry part of being a tax professional. And you'll get better as you continue to do it and as you continue to recognize the forms. But you'll just put that information in. You'll put an employer, wages, so on and so on. And then I will complete this with you all in the next class. But that is how you start a return. It's also how you input a return into the software. Well, you didn't get to see that part, but once you open, um, once you get in Crosslink, you're gonna go to tax returns, and then you're gonna select new return, and then that's gonna allow you to start a return. And then in order to start a return, you must type in the social security number of the taxpayer, not both people, just one person. So you would type in this social, but you would also put in your special number here. So if your number is 19, you put 294195656, and then you'll retype that, and then you'll start typing the information in as you see from the YouTube video. And then you would continue until you type in all the forms. So they have 2 W-2s that you'll be inputting, and then you would do not try to answer the learning activity questions because this software is in 2025. The class is in 2018. The main thing I want you to learn right now is just how to do data entry. And I want you to just input the information from the W-2 or the tax form into the software. That's the main thing I want you to take on. All right. So, like I say, you all will get your login no later than Thursday, Friday morning. I thank you all for the opportunity. And yeah, we cooking with grease now. We cooking with grease. Does anyone have any questions for me? And you find the learning activity by going into the chapter, which is the PDF, then scrolling all the way down to the bottom, and you'll see the learning activity. Now, I do want you to use the chapter to do your study questions, though. The study questions you can answer by reading the chapter and then using the chapter to answer the study questions. So I do want you to do that too. So we'll review chapter 2 study questions on the next class on Tuesday. And then we also will go over the learning activity for chapter 2 and, continue to keep cooking from there. But that is chapter 2. My name is Terrell, and I am the owner of PRXNCE.TAX.
I did want to ask a question when
Okay.
you was going over the medical expense deduction that a regular, filer can
I
claim.
can show you.
Would premiums be considered that, or you just saying any like medical expense other than the copay?
Any medical expense other than copays. So, now premiums, you talking about the people that's paying like their healthcare premium?
Yes.
Okay, cool. So here we go. And that's the reason y'all can still see my screen, right?
Yeah.
Okay, bet. So right now I'm in the software. So say Robert had to pay healthcare premiums, and this is also going to be reported to you. So it's right here, long-term care premiums. So yes, if the amount was, but they gotta have a receipt for showing that they put that money down, because it does affect the return, and you'll see that. Like, let me give it some money, so that way y'all can understand what I mean. So. Because you had a question on the stay on. I thought y'all was gone. But here we go. So $25,764.39. So 25,764. And I want y'all to notice over here, you see how you don't see nothing? It just says $0 in income and $0 for federal AGI. Y'all see that? Well, of course, but that's what that is. So now you give him his $25,000 that he made for the year, right there. And now he has a federal refund because he has 3 kids he claimed, and they all under the age of 17. And then you add in the amount that's federally tax withheld. This is one of the most important numbers on the W-2 because if nothing ain't right here, he just has 7,350. But when you add in when he allows himself to pay taxes throughout the year, and like I was just telling y'all, that's the reason why I don't recommend that people go tax exempt, because if they pay the taxes, they will always get it right back when they file. It's just when you go tax exempt, you're making yourself owe this. So say Mr. Ryland only, and I'm going back to your question too, by the way. I just wanted to show you this first. Say Mr. Ryland, he went tax exempt the last 4 months. So instead of 3,540, he only paid 1,200, right? So he in the positive because he has 3 kids. That's the reason why he in the positive right now. But he would be in more if he actually paid his taxes. So that's what you want to explain to Mr. Robert. Be like, look, you're doing good. I'm proud of you. You get a great refund. But if you really want to maximize that refund, go ahead and pay all your taxes for the year, and then come see me. And now you're taking home $11,000 that you're finna see in 7 to 21 business days. And that we ain't even put in his other stuff. So say Mr. Robert Ryland has medical expenses and he pays $4,500, right? Let me take that off right quick just so y'all can fully see it. And then I'm also gonna add in the state. So when you messing with the Schedule A, when you helping a client report itemized deductions, it's not going to show on the federal side. The itemized deduction is going to really show, the benefit of itemizing deductions is really going to show when they're in a state. So let me show you what I mean. So go back to the W-2, and on the W-2, the state part is at the bottom. So Robert live in Alabama. Boom, boom. And then Robert made 25. What you made for the year? 25,764. Boom. Y'all see that 483? Yeah, nay, but just check me out. So the 483, the reason why he owed the state of Alabama is because Robert didn't pay no taxes to the state of Alabama. Yeah, he did pay taxes to the federal government, which is like FECA, Medicaid, and things like that. But Robert didn't choose to pay no taxes to the state when he filled out his W-4 form. And that's what we just was talking about. So clients can be like, hey, yeah, I'm paying the federal, but for some reason, state ain't taking no money out. The reason why state ain't taking no money out is because you elected not to, you going tax exempt on the state. But that's the reason why you're the tax professional. You explain that to them, and then they go to their employer, and then they get that fixed, especially before the year end over with. So Robert, like, man, I can't believe I owe the state of Alabama. To answer your question, Miss TT, this is the answer. So Robert, where my schedule go? Where you go? Schedule, see. And these are the forms right here. And everything I'm doing right now would have normally been on paper. Okay, so like all this would have filled out on paper, Robert Ryland, the dependent information. And see, he can earn income credit right now, which is the reason why he winning. Which it seemed like why he winning. But trust me, he not. He winning, but he ain't winning like he could be winning. And then I just need to schedule A. So because I added that other form, I got to re-add my schedule A on it. So you'll go to add form, and you see I say federal, state, depreciation, pro forma, index. Federal, we're in the federal return. State, we're in the state return. I already added that. Pro forma is these are what someone would use to kind of calculate someone's estimated tax from the prior years and things like that. But if they're a new client, they won't have pro forma. And then the index, it just, again, is an item, it is an index. So just like how you have an index at the end of any booklet, and it kind of tell you every page at and things like that, and it breaks it down, that's what the index is. It's an easier way to find forms if you know the form by their name. So Schedule A, we need to add that back. I hit add. Boom, I didn't mean to delete it, so now I got to Schedule A back. Now I got to Schedule A. Robert said he paid $4,500 in premiums, long care premiums to whatever care system it was. So you put in this $4,500. You saw it didn't do nothing to this $483. That's cool. But then you ask Robert, hey, Robert, did you have any other taxes you pay for? Did you have to pay for your car tag? And he like, yeah, man, I got like 3 or 4 car tags that I had to pay for. And you know it's October, so everybody renewing their car tag. It's a big one right here. So I had to pay for them car tags, and I live in Jefferson County. All right, cool. And then state and local real estate taxes. So Robert does on his home. He said he paid $909 in real estate taxes. And as you can see, it all because you putting the numbers in don't mean that it's just gonna make his state just go away. But the benefit is he's now able to itemize. This is what itemized deductions is. So you be like, Robert, anything you put down on your Schedule A, please make sure you keep a copy of it, of that record for 3 years. Put it in a Ziploc bag or whatever, but keep it in your personal record for just in case if the IRS contact you. Because the IRS don't contact the tax professional. The IRS contacts the taxpayer. So the IRS will contact Ryland, and then they'll be like, hey, we want proof that you paid this $4,500 in loan and Medicare expenses. And then we want proof that your car tag was so on and so on. And so that's what the receipt is. And then it also said that Robert paid the mortgage interest, right? So mortgage interest is normally most individual biggest deduction. Now the reason why none of this is really affecting Robert is because this is called an itemized deduction. And what I'm gonna do for you all is I'm gonna break it down so you can see it. So just so you know. All right, so here we go. Robert made $25,000 for the year. His standard deduction right now is $29,200. That's with him and his wife. And that's because he claiming marrying his wife. Because he claiming them, none of this even counted as income that he had to earn. But if you change the standard deduction to the number that Robert was back in 20, if this was only 12,000, Robert would owe a tax right now. But because it's not the number from 2017, but we're in 2024, where the standard deduction for a married couple is 2 of them together, that's the reason why he doesn't have any tentative tax, nor does he have any taxable income. Okay? And so 29 minus 25 mean that your first 29,000 that you made, you don't owe no tax to me, Robert. But if Robert was single, I just want to show it to you because I love talking taxes. This is the coolest part to me. You see how his federal amount changed? It was $11,000. He just lost $1,000. And then you go to tax summary and watch this. All right. So this further explains why the standard deduction is important. And in 2024, again, as I was stating about inflation, in our class, we're learning from it from 2018. So in 2017, 2018, the standard deduction was only $6,000. So that meant that the dollar had more buying power in 2018 than it does now in 2025, which is why milk costs more, eggs cost more, gas costs more, everything costs more. That's what that is about. So Robert made $25,000 for the year. Of that $25,000, the government said $14,600. You didn't have to pay taxes on, Mr. Robert. But guess what? Your taxable income is now $11,000 because $25,000 minus the 14 equals $11,000, which leaves him with a tentative tax of $1,118, right? The cool part is Robert got 3 kids. His 3 kids gave him the credit that cleared his tentative tax. So boom. So because he got his 3 kids, he got his EITC credit, earned income credit. You see it? And earned income credit is based on how much money you earn. So check this out. Watch this. And this is why this is also important, because this is when once you really learn this, you're gonna really be able to like decipher what it is I'm doing. And I ain't doing nothing. I'm just explaining to you the return. All right. So now look at it now. It went from $10,000 to now Robert only getting $7,000. You know, so and then now Robert has more wages. So the more wages you make, the more taxes you owe. Now watch this. You go back to tax summary. Your customer asks you, Robert and them, they ask you like, Robert, like, man, I remember I filed 3 years ago. I was getting $11,000. This is real conversation. I remember I was getting 11K a refund. And what has changed, Terrell? Or what has changed, Miss TT? I'm still filing my Schedule A exemptions, but for some reason, I'm always on the state and I get less money every year. All right, so here you go. The reason that it's changed is because, Mr. Robert Ryland, you are earning more money. And because you earn more money, the government say your first $14,600, you didn't have to pay no taxes on. And this is how you use the software to explain it to the customer, because you have the software to show to them. It ain't you doing nothing, they not around and that type of thing. Especially if they're in front of you, it's way smoother. And then you be like, so of that 35,000, the government say $21,164. You had a tentative tax of $2,309. Now, yes, you do have your children. Your 2,309 minus your 3 kids left you with 809 in total tax for the year. You see that now? So of his 809, he paid out $3,450 from this 3,000, from the 35,000. That was held from the employer with the W-4 form. Then he got his earned income credit for his 3 kids. You see how that dramatically dropped from 7 to 5? The reason base is because earned income credit is on a gradual scale where the more money you earn, the less EIC credit you receive. And the EIC credit is meant to help low-income individuals, and low-income individuals is people that make less than 16 or 14,000. So if you're making 35,000 now, guess what? You make double of what somebody that's considered low income. So yes, you still get the credit, but you don't get the maxed out credit. Just to further explain. So when you add them two together, he now at $8,531. 8,531 minus the 809 leaves Mr. Robert Ryland with a refund of $7,722. And so if Robert filed, and if he were to file with us, he'll get an estimation. And before you give him the estimate, you will put in his predefined charge. And this breaks down my charges. So I got the diamond package. I got free file, where I file people taxes for free. As long as their income is less than the standard deduction, or less than, less than the standard deduction. And then you got low income. These are people who just income is just low and they're choosing to file. And then you got bronze. So in this situation, this is Robert. It's his own children. He coming in with a W-2 and he did itemize his deductions. So normal, your own kids, it's about $350. Now, if this was Robert mother trying to claim his 3 kids, the price would be $500. And the reason being is because there's more EIC notes that's due for her versus it is for Robert claiming his own kids. Because it's more risky for someone else to claim. Even though you have the right to claim these children, you're still a more riskier return to the IRS. So it's a higher tax bracket. All right. And that break down that, so you're gonna put in that 350. And then boom. And now we at 468 that Robert gonna pay to the big bank. But guess what? You can't get paid until you go to the 8879 and you choose how you want to get paid. So refund type. If Robert get a check from the IRS, we didn't get paid. If Robert get direct deposit from the IRS, we haven't got paid. If Robert chooses to reserve his account and keep it in it's like a money account for the IRS, we ain't get paid. If Robert owe a balance, you gotta pick 4. But we use refund transfers or refund bank products, tax products, as you would like to hear. So you always gonna choose 5. Okay. Then when you choose 5, you then go to the bank application And now it breaks down what Robert will take home. And it tells you, okay, Robert, your refund was $7,722. Of that refund, you will take home approximately $7,034.10. And that's because your tax prep fee is in there, the document prep fee, and the amount paid to the transmitter. This fee and this fee do not go to nobody. That goes to the bank, which is why the 355 is all that you control as the tax professional. And no matter what e-file system you use, every bank has their own, fees and things like that. As you can see, service bureau fee, check administration fee, fast forward fee, all that. Okay. So that's just a quick little synopsis to kind of get y'all into what exactly occurred. I do hope I answered your question when it came to the Schedule A. I just get excited when I start seeing money, especially when I just made 300, when I could have, if this is your own personal client, you just made 80% of $300 or 350. So that will bring you out to like, I think it's like 279, almost 285 that you just made from doing a client tax return for maybe probably like 30 minutes. So if you do 2 or 3 of them a day, you just made 750 a day, and 750 times 5, and then 5, you got 12 weeks. You do the math. It all adds up fast, trust me. And that's just a normal person with their own kids following their own W-2. And as we continue the class, I'm gonna give y'all more and more secrets. But yeah, this is what I do. I love helping people. I love taxes, and it just helped open the door for me. I'm happy to provide you all with the top software. I'm happy to provide you with the marketing, the visuals, everything like that. So if y'all got any questions or concerns, I am available, and you always can call me. And I do hope I answered your question, Miss TT. Cool. Any more questions or concerns before I close it out for the day? Cool beans. Thank you all. And yeah, don't forget to check out that classwork Thursday. Y'all can get your email with your login. Thank you all for the opportunity to want to be a part of PRXNCE.TAX. It's so much money we finna get. So much money. All right, so peace. Oh man, I'll be working. Mm-hmm.